And
Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Bentley, CEO of Euler, to discuss the nuances of stablecoins and why they are not created equal. Michael, it's great to have you with us. Welcome to Trade Talks.
Hi, Jill. Thanks very much for having me.
All right, you got it. And give us some background on Euler.
So Euler, for those of you that are already familiar with crypto, a blockchain, Euler is a non-custodial permissionless lending protocol that allows people to lend and borrow a wide variety of crypto assets. For those of you that are less familiar with the industry and crypto and blockchain in general, what this is a piece of code. It runs on the Ethereum blockchain and it essentially matches lenders and borrowers to one another. And for the lenders, that allows them to capture value in terms of interest, and for the borrowers, who are often institutional players, they use this borrowing capabilities to be able to hedge against these very volatile markets.
And, you know, Michael, it's interesting. When I hear the name Euler, I think of like an oil and gas company. What's the genesis behind the name of the company?
So, yeah, it's a very, very sort of nerdy explanation here. Essentially, we're named after a Swiss mathematician from the 18th century, and apparently this is how you pronounce his name. Why are we named after a mathematician? Well, he's a extremely famous mathematician, and one of the things he was well known for was studying the compound interest rate formula, which gives rise to lots of fantastic mathematics, and really he popularized that formula. So we thought it was quite a nice link. One of the sort of competitors in the industry is called Compound. Obviously, they probably have the best name, so we thought we'd go with Euler instead.
Well, you know, and you can't forget that. See, learned something new today. Tell us about stablecoins and how do they work?
Yeah, well, I mean, there are a few different types. I think probably the most important type that people should know about is the asset-backed stablecoins. Essentially, these are non-volatile cryptocurrency assets, digital assets that are pegged to a fiat currency like the US dollar, for instance. The way that this works is essentially somebody will deposit $1 into a bank account somewhere. And when that's done, a new digital dollar gets printed and minted on the blockchain, where it can then be used in a whole variety of ways in decentralized finance or in cross-border payments and trading and so on. There are a few other types of stable coins as well, which maybe people are interested in. There's a very DeFi sort of native stable coin that's over collateralized. And probably the riskiest of all stable coins is the algorithmic stable coins, which gained some notoriety, shall we say, this year.
Mm-hmm. Why should ordinary people care about stablecoins?
Well, yeah, it's a great question. I think they are the killer use case for crypto, to be honest. Maybe the best use case for crypto we have today. The first thing I would say is that they're extremely efficient to use, in contrast to legacy systems, which are often opaque and take a long time to get things done in. To just give an example, you know, as a cross-border payment, if I were to, if you were to try to send me some money, let's say $10,000 today, it would probably take a couple of days. You'd have to go to the bank, with lots of red tape. It might cost you quite a bit. A lot of the transaction would go into fees. In contrast, if I had, $1 million today, I could send that live now on the stream. It would finalize in seconds, and it might cost only a couple of dollars. So these things are hugely, hugely efficient. Another big use case, though, is you and I are very lucky to live in countries where we kind of respect, or in some sense trust, the government not to interfere in our personal lives too much. Of course, most people around the world don't live in countries like that. Lots of people, in fact, live in countries with repressive or authoritarian governments. And in those cases, people are increasingly turning to stable coins as a store of value, a place to put their assets when they're worried about, talking down about their governments. If you were to try to do this in some countries, organize and kind of, complain about the government, you might find that your assets are very quickly frozen in the morning. So that's another use case. And then, of course, I can't continue without mentioning inflation, which right now is affecting lots of people around the world. It used to just be we used to think of this as something associated with developing nations, but in the UK right now we have very high inflation. In some countries in South America, they're dealing with inflation 50% plus, and in those places it makes sense, actually, I think, to park your assets and value into dollar-denominated stablecoin. People used to do this years ago. The wealthy would do this by going to a forex exchange and buying actual physical dollars, but now anybody can do this, on the blockchain.
Yeah, it's interesting that you bring that up because we tend to think so US, UK, EU centric and not realizing that billions of people around the world do use these type of assets to not only store wealth, but to transact business, especially cross border. So these, these innovative tokens or stable coins, they're being put to use already. And sometimes we don't think of it in those terms. So I'm glad you brought that up. And to wrap up here, Michael, in the last minute, why do regulators care about stable coins?
Yeah, they've increasingly started to care in the last few years, and we're starting to see positive signs now from the US, the UK, and in the EU as well. Ultimately, partly this is because stable coins have grown so big. They're now regarded as being probably too big to fail at this point. It's $150 billion market cap for these stable coins, and they transact trillions of dollars of volume a year. So if these were to fail, they might not only affect the crypto industry now, but also the broader, legacy financial systems as well. And what are regulators doing? Well, they're trying to make sure that people have more transparency in the system, which ultimately is a good thing. The worst thing for a stablecoin holder is to find one day that you can't redeem your stablecoin for $1, right? If it loses its value, it's not very stable, it's not very useful. And I guess that's one of the main things that regulators are looking towards. And I think a lot of people in the industry would welcome is making sure that there are some, constraints around what these stablecoin issuers are doing with the assets. When you put $1 in a bank account, we want to make sure that you can get $1 back out of the other side at all times.
All right, Michael, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.